The bigger they are, the harder they fall. SMCI's 20% drop on Friday drew a lot of attention, especially as nVidia is set to report earnings after close this Wednesday. So is AI mania about to come to an end? What can we expect from nVidia's earnings and where will indices go next? Let's build a logical game plan and talk about everything in the week ahead together. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit the notification bell, like this video guys, and if you watch until the end, I got a couple of trade ideas for the week ahead. Now this is the heat map of the past week. We can immediately see some of the bigger names didn't do so well. Look at Apple, Google, Amazon, but some of them did. nVidia continues to outperform, as well as Tesla bouncing off that 185 level. It was really half and half across most industries. We did see quite a jump into healthcare and utilities, a bit of a defensive rotation after those CPI prints, as well as a bid into energy, a bit of an inflation hedge, and financials probably the best performing sector for the week all in all. That being said, there were losers, there were winners, such goes the market. Now, let's hop on the charts. Now looking at the weekly candle chart in the S&P 500, zooming in right here, we're actually going to look at candle structure and location. What we can see here is they call this a hanging man candle. It's a red bodied candle. So that means on a week open to week close basis, the bears did win. What we did see, however, was this long wick, a substantial reaction from the buyers at these lows of last week. So you could say these are equal lows. And if you want to split hairs, it's actually a slightly higher low. However, inconsequential. What we did see, however, was that the wick did wick above the high of last week. So what you can say is that the buyers are firmly in control. However, still a red bodied candle nonetheless. Now this candle does represent some slowdown in momentum. The momentum we're seeing right here and the momentum we've seen right here. However, the trend is still up. As you can see, we've made a low, higher low, higher low, confirmed by a high breaking this high right here, a higher high, and now an all-time high. And on the weekly chart, we can actually afford a pullback all the way to the 47.77, call it the 47.70 area. Why? It's aligned with the previous all-time high we made here in early 2021. And based on this, what we are actually looking for is an opportunity for the markets to sort of pull back to this area and then go higher. So we are looking for opportunities to buy in this area right here. Now, we are constructively bullish on the weekly chart, even if we do go as low as the 46.90 area, but it does get a bit grim on the weekly chart below this area. However, on a monthly chart basis, until we break the 41.25 level right here, we're still very, very well in control of the overall uptrend in the market, and there's no technical damage on this chart. At the end of the day, you have to understand that we do get pullbacks, we do get red weeks. The market doesn't just go up all the time. Now guys, yes, because of this candle, the trend is slowing down. You can clearly see that, but there is no indications that we're about to pull back or anything really sinister is happening in the indices right now. What this tells us is that we should constructively look for pullbacks, and this chart is constructively bullish for us to go ahead into that 5,000, 5,100, 5,200 area. So on the daily chart, we are still firmly in an uptrend. You could see here a low, higher low, higher low, higher low. At the same time, we print a high, higher high, higher high. But this candle right here was still a part of this weekly sequence. So what I would actually call this, based on last Friday's candle right there and the close of this week, I would say that we're currently in an equal high. Now this opens us up to two possible opportunities for the week ahead. The first scenario is quite simple. We got an equal high right here. We just go blast right through, make a new all-time high, trend continuation. A second type of trend continuation that we might see, especially if we stay above this line right here, is sort of like an ascending triangle forming where we sort of just do this and then break higher. But nonetheless, what we are looking for is in scenario one is a break above these all-time highs. That's what the buyers and the bulls want to see. And just do remember, as long as we're above this 47.70 area, we are constructively bullish, looking for all dips to be bought. In scenario two, what the bears want to do in the week ahead is use this double top as a bearish formation to push price lower into this area right here, call it 49.20. That's where a lot of bulls will find value, and from there the bears will need to continue to work to push us below this 49.20 area if they really want to see lower price action. Buyers will need to hold the 49.20 area, otherwise being in the window of weakness, we will see lower price action. However, if the bears can't get below or to the 49.20 area by Thursday close, they've lost a lot of their opportunity and they've lost the window of weakness to take price lower, and then we probably do go higher. And all we're looking for this week is some form of a higher low to form somewhere here around this 49.20 area. If we do get that, we're going to look for buy side strength opportunities to go higher. However, if we do slip below this 49.20 area, the bears do get the benefit of the doubt, and then we might actually go lower. That being said, you do want to watch this area right now, 49.20, and all in all, this chart does look bullish. Nothing last week actually made any technical damage because we did print a slightly higher low right there. We came in at these equal lows, still a constructively bullish chart when you look at it. Let's move on to the Russell. Starting with the weekly chart in the Russell, we're actually going to look at candle structure and location. Now, looking slightly more constructive here in the Russell in terms of the candle we saw, it's a green bodied candle with quite a long bottom wick and a long top wick. Now, buyers did come in a very big way, and so too did sellers at the top. So we are sort of balancing in this range. That being said, we actually did print a higher low compared to the last week, and we could sort of see, I would call it equal highs compared to this high right here, slightly lower, but again, you are splitting hairs right there. That being said, compared to this low right here, we actually did print a higher low. When you look at this low right here, high, then higher low, and now we're going in for an equal high. And what the Russell needs to do next week is look to break out of this range that we're currently forming right here. Now, if we do get a breakout of this range, call it multiple daily closes above highs as well, maybe approaching this level right here, a weekly close above this range, and a measured move takes us to pretty much near all-time highs in the Russell. So now if we are actually to measure that move from rectangle to the top of the rectangle, we are looking at 19.5. Let's call it 20%, cap it even right there. But right now for the Russell, a lot is going to depend on what happens in this area right now. Is this a bearish double top formation that's going to take us lower, or are we going to break out into this rectangle, come down, use a support, and then go higher and hit new all-time highs and also clear some of these levels along the way? But if you actually have a look at this is actually looking largely constructive. I mean, considering that we got an uptrend right here and we're kind of flagging out, you would consider that a bull flag, and now all we want to see is just the breakout. Now, looking at the daily chart, this is where it gets absolutely mission critical. So you can see here that we are actually in an uptrend. We got a high, we got a higher high, we got a low, we got a higher low, higher low, higher low right here. And this means we can actually afford a pullback to this level right here. It's absolutely key. So if the Russell is to pull back, the trend won't be jeopardized as long as we stay above this line right here. It does get a bit dicey if we do go below, but a pullback into here and moving higher is actually going to be a tailwind for the S&P 500 and a broadening out. Now, we did put in a high and we are looking to break this high as well, but we did put in a higher high. If we do go below this line and possibly below this 191 area, things are going to look grim for that Russell, because then that would actually be a higher low and then a lower low, and then we might actually see a downtrend in the Russell. That being said, things are looking constructively bullish as long as we are above this 198 area in the Russell, looking for all dips to be bought. Now, this Friday bar does not look encouraging. It's an inside bar, a huge gap down, red day, very rough day in the IWM. It was negative 1.36 on Friday. Now, this does tell us that sellers definitely stepped up in a very big way here on Friday, especially after PPI, and the buyers do need to hold this area, otherwise it can look a bit dicey for small caps, especially if yields continue their trajectory upwards, as you can see right here. But ideally, what we want to see in the Russell 2000 is sort of like this, and then a break above and go ahead and break these highs right here. Break out of that massive consolidation we've been in for the last 12 to 18 months. Now, does the breakdown below the 198 area jeopardize the trend? Yes, only if we break below this area right here. I mean, until then, we can actually look for dips, but it does get a bit dicey below the 198 area, and really, buyers really need to step up right here. Otherwise, we might see the whole market come undone, at least for the week. But the trend is up, and we will align ourselves with that, as in all dips to be bought in the Russell, looking for higher price action. And we are up like 25-30% in the last 3 months for the Russell 2000, as you can see right here on the daily chart. Now, with regards to the Nasdaq 100, I'm not going to go over it because it's pretty much exactly the same as the S&P 500. There's no real change on the monthly chart, the weekly chart. However, on the daily chart, it is looking a little bit weaker. That being said, all principles still apply as the S&P 500. It's just that Friday's bar is looking a lot more grim than the S&P 500 overall. Now guys, the weekend poll is currently underway, so go to the YouTube community tab and go cast your votes. Right now we are seeing 62% of participants have voted the next 100 points in the S&P 500 will be down, so go cast your vote right now guys. Now looking at sentiment, we look at these two indicators almost every week and they're starting to diverge from each other. The BOFA bull bear indicator moved down from 6.6. The Goldman Sachs sentiment indicator is now officially in stretch positioning, and while the sentiment overall is still whole, well, at least the Goldman Sachs indicator is telling us that maybe some of your winners that you've had, technology, semiconductors, maybe it is time to just trim them a little bit, maybe by 5%, maybe by 10%, and move into other sectors that are not quite as loved as those because they may outperform. Maybe you don't want to rotate into other sectors. Maybe you just want to hold cash. You're still getting 4 to 5% in money market funds, and that's a very healthy return. Either way, both these indicators are telling us right now to either hold what you got, find value, or pile up some cash. Now guys, I got a trade here for you guys. This is the Nasdaq 100 where the President's Day and February OPEX coincide. They do coincide every now and then, and when they do, we can actually look at short trades. This is a negative trade, so you can see here that up years, down years, there's more on the downside, and this is very, very healthy returns. 22 losses, 7 wins in terms of positive versus negative days in that week. This is a short side trade to extract alpha. And what we really want to do is enter the trade on Tuesday and then exit sometime on Thursday. Average return Tuesday to Thursday, normally negative 0.69%. And you could see that when we negative, we're really, really negative. And when we are positive, they're far and few between. So I do think that the risk to reward here is definitely very good, but you do want to be out of the trade by Friday because Friday tends to be very, very positive with a 0.29% return, 20 wins, 9 losses. Now, we got a note off BOFA's trade desk right here, and they said, we raise our year-end S&P 500 index target to 5,200 from 5,000, representing 4% upside from the current level. Increased profit estimates are the driver of the revision. We expect PE valuation multiples for the equal weight at 16x, and the market cap weighted at 20x will remain close to the current levels, making earnings growth the primary driver of remaining upside this year. And the reason why we're seeing earnings outperform has to do with the improving macro and fundamental outlook. And that is leading to quite a number of earnings surprises. Have a look at the earnings surprise factors. You can see here that every single sector has surprised to the upside. That's very, very rare. Normally, we actually only get about 50 to 60% of sectors surprise to the upside. Now, here is all the key earnings details I've broken down. Now, you can see that 2023 fourth quarter blended earnings growth right now is sitting at 9.6%. Crazy. This was negative 1.7% just 3 weeks ago. If the energy sector is excluded, the growth rate for the index is 3.1%, double-digit earnings growth. And it looks like if we continue on this path, we're looking at double-digit earnings growth, including energy, which is crazy. 395 companies have reported, 80% above analyst expectations. Blended revenue growth rate is at 3.3%. Excluding energy, we're looking at 4.7%. So companies are both increasing their top line, but further increasing their bottom line, thanks to a decreased inflation backdrop and reining in overall spending. We saw that with layoffs, efficiency, and productivity gains. Companies are making money on the top line, converting it to even more profit on the bottom line, and reporting well above analyst expectation. Now, where does this leave us with valuation in the S&P 500? Right now, we're sitting at a PE of 20.6x, a PEG ratio of 1.1, a free cash flow yield of 3.5%, and an EV to sales of 3x. Now, the cheapest sector across all of these, at least on a PE basis, is energy, but this was 10.5 just a couple of weeks ago. So we're starting to see the market as a whole become relatively more expensive as investors try to find value. That being said, the most expensive sector continues to be information technology and consumer discretionary on a PE basis. However, on a PEG basis, you actually see here that information tech looks relatively cheap, as well as comm services, healthcare as well. And then all of these other sectors that do appear cheap, like utilities and financials on a PEG basis, are quite expensive. That being said, the free cash flow yield of tech is not that great, and it does progressively get better as you move up into these cheaper sectors. But that being said, I do think it's great to have a mix of everything right here, especially, have a bit of the growth potential in tech, comm services, consumer discretionary, and some of the value plays in energy, utilities, and financials. I think a well-diversified portfolio into 2024 is prudent, and I think that's actually really good to have. Whereas in 2023, concentrated in tech was really how you really won big in 2023. Now, looking at valuation with regards to the equal weight, we can see right now that the current PE is 20x, and that means that the equal weight currently trades at a 25% discount. If you do want to buy the index as a whole, maybe look at something like the equal weight. It is currently trading at 16 times earnings compared to the market cap weighted of 20x. Now, let's actually talk about earnings this week ahead. So we actually have not necessarily a big week. We do have big names, but a very constructive week with regards to the consumer, how the economy is looking up, and how growth is looking for the most part. On Tuesday, we have Walmart, Home Depot. That's really going to tell us where the staple consumer is. Then we also have stuff like Solar Edge, Realty Income. That's going to tell us where the discretionary consumer is. Then Wednesday, the big one, all eyes are going to be on nVidia, as well as stuff like Rivian, Lucid. And then on Thursday, we actually have a lot of tech names: Nikola, Fiverr, NU, Intuit, Bookings Holdings, Mercado Libre, Carvana, Block. So a very big week of earnings in the tech names, semiconductor names, as well as consumer staples, consumer discretionary names. Now, let's actually talk about nVidia. Now, Bofa left this note right here, and let's read it together. We're not going to go through everything. I'm just going to go through these major parts. Now, they reiterate a buy rating with a price target of 800. They believe that nVidia is the top pick ahead of its earnings, but they won't be surprised to see don't be surprised to see a notable but brief pullback after the parabolic run. Bloomberg options indicate an 11% implied move post earnings. Expectations are for 2023 for the fourth quarter and 2024 quarter one of $21.7 billion in sales and $23 billion respectively. And that should be a 9% and 7% above the consensus, leaving us with room for more upside surprises. They do expect stock volatility to be short-lived, especially as investors look ahead to NVIDIA's flagship GPU tech conference. Now, with regards to valuation, NVIDIA's stock valuation remains compelling at 35x CY 2024, but still below the 41 times median, which is towards the lower end of the 45 to 67 range. Any post-earnings volatility should take the stock to no worse than 25 to 30x next 12 months earnings. And actually, if we do get there, I may even be a buyer of NVIDIA. Now, where does this leave us with the overall semiconductor sector? In our view, we are at worst in the middle innings of an upfront 3-year spending cycle, with likely demand stretching out to at least mid to late calendar year 2025. Now, guys, there are some risks to this. A couple of analysts think a bit differently. They said that customer discussions confirm NVIDIA's lead times have come in substantially over the past few months, meaning shipment slots are still available in the second half of 2024. Now, why is that important? The reason why NVIDIA's earnings have been so blockbuster is because their H100 chip, there's been a huge demand for them, and they aren't able to get that supply out as quickly. But now that supply is coming back into balance with demand, what does that mean for prices? What does that mean for lead times? And what does that mean for future earnings? That being said, looking at NVIDIA's valuation, we are currently sitting right here. NVIDIA is trading at about a 35x PE. And if you actually have a look at historically, this is in the lower end of the range. NVIDIA has traded as high as 70x and as low as probably 25x, but we are closer to the lower end of the range than we are to the upper end. And we can definitely see that this valuation at the moment is currently driven by earnings growth more than multiple expansion. But I do think what's happening here is that NVIDIA's PE is compressing. We do tend to see this with growth stocks. They demand quite a high PE, and then it does compress as we finally get those blockbuster earnings. And that's what we're seeing with NVIDIA. So I do expect a trading range, maybe 25x to 35x for NVIDIA over the next couple of years. So you don't really want to be a buyer here, but if we do get to this 25, maybe 20 range, we'll see what guidance is. That's going to be a compelling place to buy NVIDIA, especially for the long term. Now let's switch gears and talk about super investors. And I want to talk about what Bill Gates did in the Bill and Melinda Gates Foundation Trust. Now, they sold a huge amount of equities. They actually had a huge portfolio, well over 50 stocks, maybe 75 stocks. And you can see, look at all these names they sold. They sold a bit of Microsoft, Berkshire, Meta, Adobe, Applied Materials, Amgen, AMP, Amazon, AVGO, Bookings Holdings. This is quite a heavy tech-weighted, growth-weighted portfolio, and they sold all of this, and this is what they currently hold. Now, look at all of these, okay? Let's exclude Microsoft. Look at Berkshire, CNI, WM, CAT, DE, ECL, KOF, Coca-Cola, Walmart, you can see that now the Bill Gates and Melinda Gates Foundation hold a lot of value names. These are value right here. Now there is Microsoft, there is growth names. Let's be real, stuff like Carvana, on, those are all growth names. But compared to what they had previously, they rotated out of growth into value stocks, or at least holding the value stocks that they do have. And that's very, very interesting that Bill and Melinda Gates, or the foundation, did that. I wonder what they're seeing ahead. Now, I did go ahead and try and find what they could be looking at, and this is some data I found. After the first Fed cut, value led growth for 6 months, small led larger, and bonds led stocks. So we could see here that when we do cut rates at this point right here, value against growth, value outperformed 3 months later. 6 months later, value outperformed, and then growth outperformed after 12 months or into the 12-month period. So that could be what the Bill and Melinda Gates Foundation is positioning for. We could also see that they did move out of a lot of their larger names into smaller names, but I would consider most of the stocks they hold still to be kind of large caps, more mid caps as well. Just something really interesting there, guys. Nothing really to go off. It shouldn't dictate what you do in the stock market, but just some interesting data I'd like to bring to your guys' attention. Now, looking at a couple of trade ideas this week, this is UPS, United Parcel Service. Now, this right here was the earnings gap down, pretty brutal. What we did see was a further continuation to the downside, a bottom right here at these equal lows, a move up, a fake out, a higher low, and now we've actually pushed above this supply area right here. If we can actually make it above the 149 area in UPS, use as support, we can actually take trades all the way to this gap up here and close the gap in UPS. There's very thin volume in this area, and we should get there very, very quickly. A second trade idea we're looking at is JP Morgan. This is a trade I gave you guys last week. We were looking at a breakout above this line, a move up. That's exactly what we got. And now we can actually look for continuation upon this 3-bar play, and we can actually look at the 185 area in JP Morgan. And we do know that financials as a whole, the XLF and the financial sector, Visa, MasterCard, everything in between is looking very, very bullish. That's one of my winning sectors for this year, and leading that charge is going to be JP Morgan. By the way, you think it can't go higher? It can. This is still very underrated. JP Morgan trades at a 14x PE. This bank can easily trade at 18x in my personal opinion. Now, data in the week ahead. There's not a lot of data. We have quite a number of Fed speakers speaking, but the focus next week is on FOMC minutes, manufacturing services PMI, and existing home sales. We also have initial jobless claims, but all in all, a fairly light week in data. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, guys, leave a comment and like this video. Cheers.